Good day and welcome to our latest Finance Research Showcase at the UTS Business School on today's beautiful and sunny Friday afternoon. My name is Gerhard Hambusch, and on behalf of the Finance Department at the UTS Business School, we'd like to provide a warm welcome to the audience, our presenters and industry guests. Thank you all for joining. We're excited to have you. A quick disclosure, we are recording this event for educational purposes. By partaking in the event, you agree to the recording. We're excited to have three UTS Finance researchers today who will present some of their latest fresh finance research. Topics discussed will include insider trading, green bonds, and mutual fund holdings. To allow the audience to meet our presenters and industry guests, I would like to ask them to briefly introduce themselves. Please share your backgrounds, expertise, and if you like, any fun fact about yourself. I will start with Dr. Vinay Patel, and Vinay, if I may ask you to quickly introduce yourself, please, to the audience.
G'day guys, my name is Vinay Patel. I'm a senior lecturer at the UTS Business School. I teach in the undergraduate finance program, and my research interests include insider trading, market efficiency, liquidity, and asset pricing in stock and options markets. In terms of the fun fact, my fun fact is that I'm a die-hard Liverpool Football Club fan, and I have played on the hallowed turf at Anfield, too much to my students love to troll me about that.
Vinay, thanks for joining us today and for bringing your insider trading research. Our next researcher is Dr. Kylie-Anne Richards, who will present on green bonds, please.
Yeah, thanks, Gerhard. So I'm a lecturer at the UTS Business School and have been for the last couple of years. I'm also still involved within the finance industry, doing some work with Fort Lake Asset Management and very much in the ESG space. So my areas, well, my background is in statistics, but my area of focus is sustainable finance, ESG and green finance. So I'm currently teaching UTS's first sustainable finance course in the Master of Finance, and we're also looking at creating other courses in that space. My fun fact, I didn't actually realise we had to give a fun fact, and I should know this is one of Gerhard's questions he likes to ask of presenters. So the motorbike helmet that you see in the background is in fact mine. So that is my fun fact.
Thank you very much, Kylie. And I may also add that you are the co-lead here with the industry engagement events and work with us in the finance group to engage industry partners with students and also with our stakeholders. Dr. Hardy Hulley will talk about mutual fund holdings. Hardy, if I may ask you to introduce yourself.
Thanks, Gerhard. So my name is Hardy Hulley. I'm also a senior lecturer in finance at UTS. My areas are, have been traditionally quantitative finance, but I've been publishing most recently in mutual funds, and I'm also working in corporate finance now. I teach, well, I've taught sort of all over in the department, sort of most recently in the Master of Finance degree. And I guess my fun fact is that 5 minutes ago, or 10 minutes ago before we started, I was busy feeding my tarantulas.
Okay, then I didn't know that about you, Hardy, and we have to talk about that later, but that sounds like an exciting hobby. I hope they enjoyed that, I guess, breakfast. We also have, importantly, we have a guest, and to provide our guests with a view on the relevance and potential impact of the research presented, we have invited Dr. David Walsh, who is Head of Investments at Real Index Investments. As a PhD-trained investment expert, David is the ideal sparring partner for our researchers today. David, welcome to the showcase. May I please ask you for your brief self-introduction?
Yes, thank you, Gerhard, and thanks everyone for the invite, and I'm looking forward to today. I'm head of investments at Real Index Investments, and I've been there for coming up to 2 years now. I've been acting in quantitative investment management for a little over 20 years in a variety of roles, research, portfolio management, and the last 10 years or so running teams. My background, I started my first career was in engineering, and I worked in mining and power industries, electronic engineering, and then was an academic teaching in quantitative finance for a few years before I joined the markets. Really looking forward to today. My fun fact is not about me, it's about the name, David Walsh, fairly common name, and I'm not the guy that owns the Mona in Tasmania, in case you're wondering.
Brilliant. Thank you, David. And I'm glad yesterday we talked from your offices with 6 trading screens in the background. Given that we're talking insider trading today, it's good to see that we're not having screens in the background that perhaps relate to your firm's trading. Thank you for that.
No problem.
The format of today's event is simple. For any topic, we will spend 5 minutes each on presentation, industry comment, and audience Q&A. Please submit, the audience that is, please submit your questions in Zoom via the Q&A button, and we'll try to attend to that during those last 5 minutes in each presenter's 15-minute slot. We start with Dr. Vinay Patel, who will tackle an important question. How much insider trading happens in stock market?
Again, good afternoon, everyone. Thanks for tuning in during your lunch hour. So this work is with Professor Charles Putnams, who's also at the UTS Business School. And what we're looking at today is we're focusing on illegal insider trading, which is trading on non-public material information to make a profit or avoid a loss. So sort of the background behind this is like significant resources are spent by regulators in combating insider trading. So for example, last year, the SEC or the US SEC spent approximately more than $500 million and used more than 1,000 staff to combat insider trading. So whilst I think most would agree that insider trading probably occurs, opinions significantly vary as to how much insider trading actually occurs and how this varies through time. So for example, we've got an article here, and what it's saying essentially is that US Attorney Preet Bharara indicates that illegal insider trading is rampant. It is undertaken by company insiders and individuals connected to them. On the other hand, SEC prosecutions provide a lower bound estimate for the amount of insider trading which takes place. We've got a graph here. Basically, it's showing that approximately 50 cases of insider trading are prosecuted per annum. So therefore, it is unclear as to how much insider trading happens in stock markets and also what fraction of this insider trading is detected. So we aim to answer these 2 questions in our research. And other related questions that we attempt to answer include, in which stocks is insider trading more likely to occur? And what makes a given instance of insider trading more likely to be detected? So these questions essentially have remained elusive because insider trading prosecutions represent a non-random subset, not the entire or not the population of insider trading. So we're going to attempt to overcome these issues using hand-collected data on all prosecuted cases in the US over the last 20 years, and also using a model which recognizes that in the absence of a prosecution case or an instance of insider trading which has been detected and prosecuted, that either insider trading occurred but was not detected, or that no insider trading occurred, and it assigns probabilities to those outcomes. So just to sort of dive straight into, I guess, sort of the key findings, we focus on insider trading in M&As or mergers and acquisition announcements, as well as earnings announcements. So we've got 2 sort of plots here. The results in red relate to M&As. The results in blue relate to earnings. These solid lines essentially represent our estimates for the amount of insider trading, and these dashed lines represent the proportion of announcements in which insider trading is detected and prosecuted by the SEC. So what we find for M&As is that we estimate that on average, insider trading approximately occurs in 20% of M&As and in 5% of earnings announcements. So what we can also see from these plots is that these solid lines are above the dashed lines. So that's indicating to us that insider trading is at least 4 times larger than as indicated by prosecution cases, indicating that prosecution cases are the tip of the iceberg. Furthermore, we also estimate that in this bottom graph here, which shows the trends through time, that insider trading is detected in approximately 15% of M&A announcements and in 15% of earnings announcements. So these estimates are consistent with rational crime theories, which indicate that no rational insider would undertake insider trading if the detection rate was too high. Just to sort of, since we've got the plots up here to sort of speak about some of the time series trends. So what we see is between 1996 and about 2007, insider trading appears to increase for M&As as well as for earnings announcements. And this also corresponds with increases in stock liquidity over this time horizon, which is consistent with insiders trading strategically, hiding their trades, and increasing their trading profits. In terms of the back end of our sample period, well, we see for M&As that insider trading seems to sort of decline after 2010. The same happens for earnings announcements, and for detection at the bottom graph here, the detection rate appears to increase after 2010. So these trends are consistent with the introduction of the SEC Whistleblower Rewards Program in 2010. This rule or regulation change essentially provides monetary rewards to whistleblowers of instances of insider trading. And what our results tend to imply is that this rule change or regulation change has been relatively successful in decreasing the amount of insider trading and increasing the detection rate. And the last time series trend I want to talk about is basically the detection rate seems to increase for our sample period, especially for earnings announcements. This corresponds with increases in regulatory budget, which increases by about 8-fold during our sample period. Okay, and just to sort of touch on a few more characteristics which we've found to be associated with insider trading and its detection. So earlier I mentioned that if the stock liquidity is high, this tends to be associated with higher amounts of insider trading. In addition, we find that insider trading, or the amount of insider trading, is positively correlated to the value of information and opportunities for information leakage. And in regards to the detection of insider trading, so earlier the graph sort of implied that the detection rate increases with regulatory budget and the whistleblower rewards program. We also find that the detection rate, or the amount of detection, is positively correlated to abnormal trading activity occurring prior to the announcement date. So that was just, I guess, a quick sort of recap of the main things we tried to look at, the main results. If you would like to get some more information about how we did these types of things, feel free to check out the paper on SSRN. Otherwise, thank you very much for tuning in. If you want to get in touch with myself or Talis, feel free to contact us after the presentation. Otherwise, I look forward to David's commentary. So thank you.
Vinay, thank you very much for this presentation. And David Walsh will be now providing his industry commentary. Thank
you, Gerhard, and thanks, Vinay. Very interesting area and very topical at the moment as well. I can't add very much to the insight that you provided in this paper. I had a quick read of the paper itself, and I think it's very interesting, a lot of good insight in there. I like the tool that was being used for estimation, the detection control estimation model. I might take that away and explore that a little bit more later, but that's not what I'm going to comment about today. Certainly a very topical area. A lot of press recently on the lack of detection and enforcement. Number of cases in the US is actually down, but the thoughts are, as Vinay suggested, that the volume is actually up, even despite the more recent whistleblower moves. A couple of examples recently come up: 2020 congressional insider trading scandal, which you can Google. You may be aware of this already, but a number of senators were accused, perhaps rightly, of trading on private information as a result of a closed Senate meeting on COVID in 2020. In February 2020. I think only one of those still remains, but a very hot topic. and more recently in foreign exchange, where you've seen some news recently about what's called the sure thing. If you read that in the Financial Review about a foreign exchange insider trading scandal there. I found this very interesting. I find this a very interesting topic, and I've spent a bit of time studying it many years ago. When I first started looking into quantitative finance, doing my PhD, part of my research was aligned with this area, and I spent some time talking to prosecutors and ex-federal police who were investigating some of this material. It was quite interesting to hear them say that it was very hard to police, and that at the time, most insider trading cases they found were self-documented by the perpetuator, by the individual who's doing the insider trading. It was very hard to find a regulation, very hard to prosecute unless actual documentation took place. So it's quite a topical area. The area associated is with what's called NPPSI, or non-private price-sensitive information. And most investment institutions, including one that I work for, have very strict regulations about the disclosure of this and the trading associated with it. In fact, we're all required to disclose our own holdings and get approval for any trading, and to have any kind of trades associated with that screened, associated with it if there's any NPPSI involved. Worth remembering that not all insider trading is actually illegal. Public trading by insiders is disclosed, and so if you're a corporate insider, you can trade as an insider to that, as a formally declared insider, and you're allowed to do that, and as long as you disclose, that's quite okay to do so. In the ASX listing rules, Appendix 3X, 3Y and 3Z actually cover the disclosure required by institutional traders, by insiders, my apologies. As an institutional trader, I find this an interesting area because there's clearly information that's put up by the insiders themselves. If it's worth being able to pick up what they trade and how they trade, it could be fairly informative, because clearly the insiders to the organisation know more about it than the outsiders do. But how you go about doing that and applying it's not clear, because a lot of the regulations globally change, and there's no central database to capture all this sort of information either. Not just the prosecutions, but actually the capturing of the trades by insiders themselves. It's quite interesting to see that there's potential there for investment signal, which a lot of investment managers will use to try and detect whether there is potential in trading, profitable trading on the back of publicly disclosed insider information. And that leads to a couple of thoughts about where this paper's going as well. A lot of the work that's been done would suggest, particularly in Australia, that there's very little information in publicly disclosed insider trading. In fact, most of it, if there is any, is associated with small cap buy trades rather than anything else, and potentially more recently in trades which are omitted. So an insider who trades regularly and stops trading may actually be quite an interesting signal, because that may indicate a lack of buying may indicate a sell, or a lack of selling may indicate a buy. So a very interesting topic. I'd like to read more about it, and I think this is, from a market perspective, a very topical area. From a regulatory perspective, a very topical area. I'd raise two questions if I can. Don't need to be addressed now, just thoughts. The first one is, if insider trading is actually going to appear to be increasing, and we're seeing increasing, or it's not being caught as much, how does work like this lead to better regulation? What do we learn from this regarding what regulators or what the market can do to reduce this insider trading volume if it is not being decreased? And should they? Because markets need to be efficient, information needs to be processed into price. If you spend the money to do the research, is that inside information, or is it formal trading of events in the way that this paper suggested it regarding M&A, for example? So should it be? Is there any read we get from this on what the regulators might be able to do? And the second question, which is a more selfish one, is associated with how we can use this technology as a predictive tool. Is it possible to understand how we might tilt a portfolio or a set of strategies towards less informed or more informed trade flow? Is it possible to do this? Can we use this tool to assess where information asymmetry might exist more in the market? And if you possess an information asymmetry, can you use that information as a way of trading? I'd be keen to think more about that as well. But very interesting. I really like the research, and the presentation's interesting too. Thanks, Vinay.
David, thank you very much. And Vinay, I'm handing those questions over to you. We also have two Q&A questions. If you can be very brief at addressing these, please, because we're running a bit over time.
Thanks, David, for the commentary. So some interesting points there. In terms of, I think, your first comment, I guess one of the aims of this research is to sort of highlight what are the characteristics of insider trading and of how it's detected. And so one of the main issues with doing this is basically a big sample selection bias, whereas if you look at prosecuted cases of insider trading only, they represent a subset of everything. We're trying to sort of estimate characteristics which apply to insider trading and its detection over the population. So I guess one of the main aims of this research is to inform regulators as to what are the characteristics of insider trading and its detection, that hopefully can provide them with more targeted surveillance efforts in specific areas or based on specific characteristics. And hopefully, possibly that these characteristics that we've identified could be used to predict insider trading, which happens going forward. But that's something I'd probably have to look at in a bit more detail.
Thank you, Vinay. Sorry. You had more to offer.
Do we have more time or?
Probably 1 minute, and then I have 2 more questions that you need to address rather briefly, please.
Okay, so we see one question here on the Q&A. It says, why do we see insider trading drop off, I think, in earnings announcements after 2010? So one possible explanation for that is the introduction of the SEC Whistleblower Rewards Program. So the rewards program essentially is providing rewards to individuals or whistleblowers of insider trading. So it's giving them an incentive to report insider trading, and that could be a possible explanation for why we see the decline after 2010. And in regards to the second question,
Allow me to read out the question. Do you know what percentage of detected insider trading is due to whistleblowers, especially in the post-2010 period?
Yes, that's a good question. I guess it sort of relates to the first question as well. I don't have that data on me right now, but I think it would be something worth looking at, and that could provide sort of a more thorough answer to whether or how successful this whistleblower rewards program is.
Thank you very much, Vinay, and thank you, David, for your comments. We have to move on from insider trading to the next topic. I would like to emphasize David's tip of the sure thing, which is a podcast series by Angus Grigg from the AFR. And recently, when I was running around and walking the dogs, I enjoyed listening to that 5-episode show. So if you haven't checked that out, I can highly recommend that. So thanks, David, for bringing that up. Our second topic today is green bond performance and risk indicators, which will be presented by Dr. Kylie-Anne Richards.
Okay, so thanks very much, Gerhard. And many thanks to those who've joined the UTS research discussion today. It is a great opportunity for us researchers to road test our ideas, particularly for this topic that I've been working on, as it's quite new research. So my talk today is entitled Green Bond Performance and Risk Indicators. So this work is with Marta Campi from the University College of London and also Professor Gareth Peters from Heriot-Watt University. So what are green bonds? So green bonds enable capital raising, investment for new and existing projects for environmental benefits. So I guess if we put it another way, the green bond market aims to enable and develop the key role that debt markets can play in funding projects to contribute to environmental sustainability. The green bond principles promote integrity in the green bond market through guidelines that recommend transparency, disclosure and reporting. And it's worth noting that these are voluntary guidelines. And green bonds are often issued by major banks, which identify assets, loans on their books that might meet these relevant criteria. They've also been issued by governments, universities and listed companies and private companies that fund projects that benefit the environment. And I think just for some Australian context, so Woolworths is the largest company to issue a green bond. Now, for investors buying green bonds, it helps fund projects focused on issues such as energy efficiency, recycling, waste reduction, and so on. And for the sustainable sector, green bond issuance helps identify institutions likely to fund those new projects. So projects that qualify for green bond issuance can be allocated, I think, broadly into these categories that we see here. So basically, I guess to summarise it briefly, the use of proceeds for green bond projects need to fall within, say, renewable energy, energy efficiency, clean transportation, green buildings, There's a full list of the details around that on the ICMA website if you are interested in it. So now moving into, I guess, the some of the motivation behind the research which I'm presenting today. So we start with the question of what is greenwashing. So this is simply the suggestion of a purpose without intent. So in the context of the green bond market, we're talking about greenwashing being occurring when a company or organisation spends more time and money on marketing themselves as environmentally friendly rather than actually minimising their environmental impact. So as you can imagine, this undermines the functioning of this market. And I guess that brings us back to the participants and what they need in order to avoid greenwashing. So issuers require guidance on the key components involved in launching a credible green bond. Investors need to have access to credible information which is necessary to evaluate the environmental impacts of their green bond investments. Then you have underwriters, which require standard disclosures to facilitate transactions. And then, of course, there's the regulators. Now, if we consider the US as a starting point, so the US munis, so we're talking about districts here where there's a local government and they have vast infrastructure. So I'm just trying to set the scene a little bit for the research. So we talk about vast infrastructure, climate mitigation and adaptation investment needs. And some quick stats. So the US, more than 60% of their carbon emissions come from buildings in which people, they live, work and transportation systems. So the majority of their environmental impact arises from cities. Now the muni bonds are one financing tool that's well suited to close the US infrastructure and investment gap. And the market's large, so investors are holding trillions of dollars of US muni debt. Now the screenshot that you see here, this is, so in terms of monitoring the use of proceeds and report annually. So this is taken from the Green City Bonds report titled How to Issue a Green Muni Bond. And this is, this report was backed by the Climate Bonds Initiative and various other organisations. Now you can see that the reporting annually, then this is done by an auditor or a letter signed by an authorised officer of the municipality, and that is it. So this raises the very important gap that exists for investors, issuers, regulators, and of course, the academic literature as well. And that's the ability to tangibly measure the impact of green bonds on climate objectives. Okay, so this is a web page which has a R Shiny app with an interactive, it's an interactive web app straight from R for those who like the sort of more technical stuff. And this is from some work that we've been doing to address this gap. So there's a huge amount of data, some fairly complex stats sitting behind this interactive that you'll see. I'll just cover off briefly around, sort of what we're looking at here from a statistics point of view and then bring that back to what we're trying to achieve. So the data consists of green munis issued in the US for the past 10 years and their attributes. It also consists of pollution and weather data taken from weather stations and other sources. So you can think of these as aggregate scores. So what we see in these, what we call helio plots, if we put it, presented that as a matrix, you'd see that as aggregate scores of performance of development of green bond infrastructure. And they're categorised into a single box plot, and it's a non-trivial score of performance. So there's multiple attributes that can contribute to the relationships between green bonds and weather and green bonds and pollution. And understanding these relationships will require some kind of projection relationship. So it's not sensible to consider that they would just be linear, and the non-linear relationships may have greater explanatory power than the linear relationships. And I guess as I go through this, you'll get a sense of why this area is quite complex, which is probably why there's still a bit of a gap that needs to be addressed. So this leads to what we call kernel principal component analysis for each city. And what we end up is with a principal component surface that you estimate from the time series. And then we want to find correlation associations between those representing surfaces. We then sample a stratified design from those surfaces and perform what we call this CCA analysis, so canonical correlation analysis on the stratified samples. And what you see here are the results. And so we get an order of prioritization of relationships through two components, the first being the principal component index and the second being the canonical variate index. And then for each principal component index, you can identify key associations between the attributes of the green bonds and then the attributes of weather or pollution by city. And so, as I said at the start, you think of it as an aggregate score of performance. And the green bond infrastructure and, say, attributes which are characteristic, they're characteristic because they characterise, say, the amount spent, the issuance, the frequency, the terms they're issued for, ratings, quality, and so on. Now, if we take a single example, say Sanjokan, so green bond development or issuance, so they're positively associated with changes in pollution. Now, I don't say reduction or increase in this case because we need to look at specific attributes to determine the direction, and that's, you know, next stages of research for this. But what's important here, moving away from the stats, is that we end up with meaningful scores, and these are akin to what you'd be more familiar with for those, you know, sort of from a business background. To key performance indicators, key risk indicators. So it enables investors to evaluate the effectiveness of green bonds issued and the reduction in greenwashing, and most importantly, that the capital attributed to the projects have tangible impacts on reducing climate change. And now I will hand over to David Walsh for his comments.
Yes, really interesting area, very topical in terms of raising capital for particular positive environmental and climate impacts through equity or through bonds, in this case through bonds. The green bond principles that ICMA suggests are pretty comprehensive, and I think you know, give you a good read if you're trying to understand what's going on in that area. It's all about positive environmental impacts. A very cool area, very topical, particularly in the area of climate change and carbon release into the atmosphere. Just a couple of background stats. Greenhouse gases are not just carbon dioxide, methane, nitrous oxide, and others contribute to the greenhouse gases. The largest one, of course, is carbon dioxide released through fossil fuel burning and general atmospheric impact on that. CO2 emissions are up from 10 billion tonnes a year in 1960 to 37 billion tonnes a year in 2020. CO2 in the atmosphere up from 220 parts per million in 1960 to 410 parts per million today, and growing quickly. Global temperature, if you read various places, suggests that we're up 1 degree on currently 2020 on the average from 1951 to 1980. So these are all critical issues. Whether you draw a correlation between them or not, the critical issues need to be addressed. And raising capital to try and invest in positive environmental outcomes is clearly a very positive and very important thing. Part of this has got to do with the transition of energy. And so energy transition strategies are a very big topic as well at the moment, how you might go about funding those. There are some suggestions to the requirements of the Paris Agreement that will need to move from globally 24% renewables in 2015 to as much as 85% renewables by 2050 to try and fund that 2%, or to say under 2% according to the Paris Agreement. And this is not an easy thing to do because a lot of the techniques around at the moment don't allow for what are called variable renewable energy techniques. So allowing for load sharing and so on among variable techniques. A lot of engineering needs to go on there. A lot of financing, not just of the events, but also the technology behind those particular operations. Concentrating solar techniques, photovoltaic solar, wind, water, things like this need to be developed much more than they currently are. And part of the funding processes to go with equities and with the green bonds is to do this. I find this a very interesting area, and I'm interested in learning a lot more about it. I don't know a great deal at the moment, and this has been very informative for me. Thank you, Kylie. A couple of comments to make. First one, I'd be interested to know what your thoughts are potentially on how this matches with the compliance carbon market or variable carbon markets as well. There's a large compliance offset requirement that comes through the carbon markets, and this is a compliance regulation quite often. And it might result in some kind of an offset that's available to organisations. So the extent to which it's an offset rather than greenwashing is a question I'd be keen to have a thought about. And then the evolution of what are called variable carbon markets as well, voluntary carbon markets, and the opportunity for voluntary submission of carbon projects and the purchasing of credits on the back of that, and how that would interact with the green bond market as well. A couple of questions further on that. One is investability. The difference between how a green bond benchmark might perform and a conventional bond benchmark perform will give you an indication perhaps of how likely it is to be picked up, because the indication from an investor is not just along the lines of whether it has green performance, but how it fits into a portfolio, how the returns that are generated as well. So those joint objectives need to be thought of too. The extent to which there's a difference between a more bland or conventional bond benchmark and a green bond benchmark will be a critical decision process in how investors take this up. The second question is, Greenwashing. How do you mitigate greenwashing? What do you do? I know it's an issue, and you've mentioned it's going to be an issue, but what do you do about it? How do you stop individuals or organisations from simply doing the process of trying to engage in these without the intent behind it? I'm not too sure how you put that in place and whether this pricing mechanism is a way to do it. That's all for me. Go ahead.
Thank you, David. And Kylie, if you want to take those two questions, and you've probably seen the Q&A, there's also an audience question that you can take away. Thank you, Kylie.
So I guess the carbon market comments, so that's probably something we'll take offline because it's the time constraints and something a bit more focused on what this was talking about. So with the greenwashing commentary and question, so I think the idea around this is trying to find ways to actually measure the impact of the use of proceeds from those green bonds. And as you said, that sometimes the greenwashing occurs without, and I'm sure it happens many times without the intent. So this will also, sort of these sorts of metrics, not specifically this, but the general, motivation behind this research will hopefully improve the allocation of capital to projects that actually have a meaningful difference on climate change mitigation. So I think that is, this is an area that, in terms of assessing the performance of those green bonds for their actual purpose, I think it's quite critical and an area that needs to be developed out further. Now, your first question, I feel like I've forgotten so there was a...
if you want to address the question of how benchmarking works for conventional benchmarks against green bond benchmarks and what incentives it might be for individuals, for organisations, investors to weigh those things up, as well as looking at the benefits from green bonds.
So I don't have a specific answer to that, but I do think you're right. That is an area that we should look into. I mean, there's plenty of discussions around, which is maybe slightly off-piste a little bit, but the green bond premium, which seems to have disappeared in recent times. So cost of capital and the motivation, particularly on the corporate side, for issuing green bonds over brown bonds, conventional bonds. And just to address the question in the chat, so did you measure the performance of green bond issuers or the performance of the projects for which the green bonds are issued for? So the answer to that is that we're collecting data for the projects. But yeah, I guess if there's an issuer that's issuing significantly more green bonds, that would be, in a way, I guess, tied in with that. So looking at Australia, the green climate bond issuers, Woolworths, NAB, IBRD and CBA providing enough reporting to manage this issue? So that's a good question, because I believe CBA, I think there were some issues around their reporting. Certainly some investors I've spoken to did not invest in those green bonds because the composition of the asset pool lacked transparency. Woolworths is an interesting one because they, my understanding, they worked with the UK-based Climate Bonds Institute, and they established a benchmark for carbon intensity for their supermarket sites. So they were a little bit more sophisticated in terms of the way that they were constructing their green bonds, and also, in a way, it's essentially a KPI for the success of those green bonds, and that will have a big impact in terms of when they return to to market to raise more capital. So I think I'll leave it there, Gerhard, because I don't want to run over on more time than I already took, I think, for the discussion.
Thank you very much, Kylie, and thank you very much, David, for your commentary. And certainly also thanks to the audience for these interesting questions, in particular the last question. We have to push on to our third project today. So do you know what is in your mutual or managed fund on a daily basis? ? I invite you to join Dr. Hardy Hulley, who will present on Inferring portfolio holdings.
The presentation I'm going to do is work that I started at the end of 2019. And with Lorenzo Casavecchia, who's a colleague of mine at in the finance department. So with Lorenzo, we've been working on, we've put one paper on mutual funds where we're looking at mutual fund performance. And if you look at the literature on mutual fund, the academic literature on mutual funds, it's really dominated by questions of mutual fund performance, mutual fund returns, mutual fund flows. And the reason is because these are the only things you can really see about managed funds. What you'd really like to know for many different applications is what's actually going on in the portfolio. But of course, mutual fund portfolios, as with all managed portfolios, are very opaque. And all that happens is you see the holdings in the rearview mirror every quarter in the case of mutual funds. So you don't really know what they're doing in between. And I don't think anyone in the academic literature, at least, has tried to get an idea of what's really going on in the portfolio. I think they just assume that this opacity is there to stay. But if you think about it, if you know what stocks the fund is trading, and we're talking about equity funds here, if you know what stocks the fund is trading, and you can get an idea of what stocks the fund is trading by looking at what its holdings are at the beginning of a period and what its holdings are at the end of a period, you'll know essentially what stocks it would have traded during that period. And you know the daily returns on the fund, and you also know the daily returns on the stocks that would have been in the fund, you can actually get a good idea of what the portfolio would have been. In other words, the daily returns of the fund leave a fingerprint of what actually happened in the fund, what really happened. So how do we infer what happened in the fund? Well, the idea really is simply that we solve an optimization problem. And we assume that the fund is trying to minimize churn. So it's trying to minimize portfolio turnover. So we say, well, let's try and construct the portfolio that minimizes portfolio turnover. So it essentially has the minimal portfolio turnover over the period. So 0 to T might be a quarter, such that the portfolio holdings at the beginning of the quarter match the observed portfolio holdings that were disclosed, and the portfolio holdings at the end of the quarter match the observed holdings at the end of the quarter. And then so that the return of our constructed portfolio matches the observed return every single day. So we're really trying to say what portfolio with the minimal amount of portfolio turnover matches everything that we can see. And before we take that to empirical data, the natural question is to say, well, how well does it work in theory? So the way to test that is by looking at a Monte Carlo experiment. So we generate a whole bunch of stock prices. So in this case, I've generated 20 stock prices, so geometric Brownian motions. And what I'm going to do in this is I'm going to construct a number of different portfolios. And then what I will do is I will use this optimization technique to see if I can figure out, if I can actually derive what the portfolio was that I actually started off with. So I'm going to see if I can actually infer the portfolio on this data. So the first portfolio is the simplest one. This is a portfolio that's a buy and hold strategy. In this case, it's a buy and hold strategy in 10 stocks. So I've picked 10 of the stocks. I hold 1 unit of the first stock, 2 units of the second stock, etc., up to 10 units of the 10th stock. And I then essentially look at the daily portfolio returns using that Monte Carlo sample of stock price data that I had. And then I solve the optimization problem and I back imply what the holdings were. And the reason you only see one set of curves over here is that the strategy captures the portfolio perfectly. So really the inferred holdings and the actual holdings are exactly the same. You don't see any deviation. If you go and look at the portfolio turnover, you'll see that the true portfolio had a turnover of 0 because it was a buy and hold strategy. There was no turnover over the time, whereas the optimized portfolio had a sort of turnover and a cumulative turnover time because that portfolio did actually trade. It wasn't really a buy and hold portfolio. It was close to it, but it wasn't quite buy and hold. But you can see by the scale over here that the amount of turnover in the inferred portfolio was really close to 0. So it did very little trading. Another strategy to look at is a strategy where you hold nothing in, or you keep your holdings at 0 in all of the stocks except for one. So one random stock, you've got a holding of 1 unit of the stock, and then halfway during the period, you switch. So you sell everything in that stock and you reinvest it in another one of the stocks. So you've got now everything held in another stock. And again, you can see that there's no difference. The inferred portfolio, the portfolio we get from the optimization problem, is really the dashed line, and it corresponds perfectly to the solid line. So that strategy of just switching from one stock to another gets picked up by this completely. Even though there's all of these 20 other stocks in there and the optimization algorithm is open to you trading in all of these things, it picks the fact that the strategy involved just switching from one of these stocks to the other. These two strategies I've looked at so far are low trading strategies. So, you either buy and hold, or you're just holding and then switching. So what happens when you have a strategy where you trade a lot? And of course, the strategy where one trades a lot is the equi-weighted strategy, right? So an equi-weighted strategy, although you're keeping the portfolio weights constant, you're actually trading a lot, because to keep the portfolio weights constant, you have to trade in the underlying stocks a lot. And here, you can't really see it, is this is an equi-weighted portfolio consisting of 20 stocks. So every stock should be 5% in the portfolio. That should be the weight. So this is the true weight over here. And these dashed lines you can see are what the optimization routine comes with. So the optimization routine is trying to observing the returns of this equi-weighted portfolio and trying to figure out what strategy would have given me those returns. And it essentially gets something where the weights lie between 4.4% and about 5.8%. But when we go and look at holdings, you can see what really happens. If we go and look at the portfolio holdings, you can see that what really happens is that in the true portfolio, equi-weighted portfolio, your holdings are actually quite volatile, because you're really trying to keep the portfolio equi-weighted. But for the inferred portfolio, all you're trying to do is minimize churn. You're trying to minimize trading volume. So you actually get a portfolio weights or portfolio holdings that track the true portfolio holdings, but in a much smoother way. And indeed, when you go and look at your portfolio turnover, you can see this is the actual turnover of the equi-weighted portfolio, which is quite large because it's a very heavily traded portfolio. But this is the turnover of the optimal portfolio, because it trades a lot less frequently. In fact, it stays close to these equi-weighted holdings, but with a much small amount of trading. But the important point about this is that even in this portfolio with 20 stocks that the algorithm doesn't, the algorithm has no idea that this is an equi-weighted portfolio. All it does is it observes the returns of the portfolio. And even in this portfolio that's very, very heavily traded, the algorithm can in actual fact figure out what the trading strategy was fairly successfully. So the idea behind this is that, when we take this now to go and look at actual managed funds, we're hoping to be able to see to get an idea of what actually happened in those periods between when fund holdings are disclosed, to actually get an idea of what really happened in the portfolio that would have given us the observed returns of the fund. All right, so thank you very much.
Fantastic.
I'll hand over to David.
Thank you. Thanks, Hardy. Very interesting approach to this problem. Something that I've thought about a bit over the years, a couple of times more seriously than others, and try and get an understanding of how you might infer holdings from competitors, for example, and how you might understand more broadly what competitors might be trying to trade, particularly if they're in the same business as you in quantitative investing, or more broadly in terms of what exposure they might be facing. For me, there are two issues associated with looking at. One is, how can you infer somebody else's holdings, whether it's a mutual fund or whatever. The second question is actually a more subtle one, is how can you infer and attribute your own performance? And the performance question is actually an interesting one, because it's quite hard to run an attribution process on your own funds quite often when you've got all kinds of constraints and cash flows and things going on. And one way to tackle that problem is to try and generate and simulate a portfolio that looks a lot like the one you currently have, and then attribute to the second portfolio rather than the first one. And then the question is, how do you make the same characteristics associated with that portfolio compared to your own? That's kind of a sort of a side issue, but it's kind of where I was coming from to try and address this problem. At its heart, Hardy's looking at the question of how do you infer holdings, knowing three sets of things. The snapshot of holdings that you get quarterly, for example, 13F filings, daily prices from the stocks that are in the universe, and daily fund values and their returns associated with those. The dimensionality of this problem is very large. You can have many, many, many different options, and you start to get a large number of stocks available in your portfolio and many days involved. It becomes a high dimensional problem. It's quite hard to infer uniquely what the answer might be. So one of the things that very preliminary thoughts I had about this a long time ago was, how do you go about reducing the dimensionality of that problem? How do you go about thinking of it? And that's probably the only sort of central value I can add to this, is to say, maybe think more about how you might add other values and other characteristics for live portfolios to try and address that. Style issues, universe constraints, sanctioned stocks, things which actually in practice will reduce the dimensionality of the problem. That could be quite an interesting way of trying to reduce the practical issues associated with this problem. Very useful to try and understand, and something I'd like to understand a lot more about myself. Macro sector style issues are going to come into that too. I would highlight a couple of practical issues need to be thought about regarding when you do this in practice. And it's not clear sometimes when you're doing this, the practical issues you find. I'll list just a handful of them. Funds aren't 100% invested in physicals. Quite often they're holding a proportion of the fund in cash. And that might be covered cash, might be uncovered cash, with a futures contract to hedge out the exposure. That number will vary through time based on the applications and redemptions in the fund. The extent to which you can infer actual holdings from unit prices will include a cash and maybe a derivatives component as well. That could vary through time based on applications and redemptions in the fund. Different rebalance frequencies are going to matter as well. If you're going to trade daily or weekly or monthly or not at all, as you noticed in your presentation, that'll make quite a difference to the results and the way in which you can infer those. And the third thing I'd mention, two things I'd mention. One is opportunistic trades. There are going to be trades which come and go into a period to drive your returns, taking on secondary offers or IPOs, which probably are going to be associated with the universe that you're looking at and maybe would not be captured by the way in which you're trying to infer them. And the last one, of course, we know 13F filings we know can be and have been sort of discussed, at least unofficially in the market, as being able to be manipulated. If they're filed quarterly, hedge funds are known to sell out their high-profile stocks just before reporting and buy them back again after the report. There's been some rumours about that, whether it's actually been documented or not. It's certainly an issue regarding the actual holdings you see if you're trying to snapshot these things quarterly. I'd add 2 points, which I don't think are going to be particularly useful given the work you're doing, because you're on a great track here and I'd be interested to see where you go with it. First one is, can you bring other things into bear to reduce the dimensionality? The universe, the style, the turnover, the way in which you reduce that will probably tell you an awful lot about the sort of style of the mutual fund or the fund you're looking at, and might make it easier to do that. Can that be done? Is it part of the toolkit you're looking at? Is the dimensionality really an issue? And maybe a question would be, maybe there's something associated that should help you to infer around particular events, where there's large macro announcements or rather large operating events in the market, large switches in regime, big rotations like we've seen since November last year. These sort of things will tell you quite a bit potentially about the way in which those funds change their positions, and in practice what you might see in terms of the holdings that they have, particularly if they're styled consistent in what they do. But like the presentation a lot, and I wish I could add more. Thank you.
Thank you, David. And I'm handing it to Hardy. So 2 questions from David Walsh, and probably the first 2 questions that we can read out from the Q&A, please.
All right. Well, let me address David's questions because they're very, very good questions. So the first thing is the dimensionality thing is exactly what I thought about. Here's the really weird thing. Just like in quantitative finance, continuous time models are much easier to work with than discrete time models. It turns out that this works better when the dimensionality is high. So the higher the dimensionality, the better the technique works. With the caveat that what you do need, what this technique really looks for is assets that have a wide range of different volatilities. So as long as you're trading in assets with a wide spread of volatilities, when you just add more and more to the market, then it actually works pretty well, because these things give strong signals. So dimensionality doesn't seem to be a problem in this, so far at least, experimentally. The performance attribution thing is a wonderful point. I didn't mention it, but I remember attending a seminar a couple of years ago where the speaker said that his criteria for a good research project is that he wants to show that X is true. And if it shows that X is true, that's great. But if X is false, then that's also a good story. And with this particular thing, even if we find that we can't really reliably see what goes on in portfolios, what we have got is a way of constructing the best portfolio that gave exactly the same performance as the observed performance. And so what we can then do is we can compare the amount of excess trading that trader did in order to get that performance relative to the minimal amount of trading. So this is another way of looking at it. It can exactly be another measure of performance. It's your return, or it's your performance, whatever it was, relative to the amount of trading you did, the optimal amount of trading. I think the points you have about cash is a valid point, and funds with derivatives and so on. You'll obviously need to know the returns of all the assets that are in the portfolio. There's also, when you come to managed funds, there's also another issue that I haven't touched on that complicates matters, which is flows. you've actually have daily flows in and out of these funds. And so that, from a programming perspective, you have to get a hold of that as well. I'll turn quickly to some of the questions on the Q&A. I see one here where it said, what's the problem that you're trying to solve? Over 50% of mutual funds disclose monthly portfolios. That's true. I will say that what we're trying to get is daily portfolio holdings out of this. But more importantly, the thing we'd really like to be able to do with this is, let's say that some event happens and a whole bunch of funds switch into some stock because it's going to do very well. Some news comes out. We'd like to be able to look at those funds and see which one did it first. So can we see the trace in the returns of the fund that actually first made a particular play before all the other ones did? At the end of the month or at the end of the quarter, when they disclose their holdings, you're all going to see that they're overweight in that stock. But who got in there first? And that's another interesting way of actually, in a more concrete way, addressing managerial skill, is like, which of these guys actually move quickest into good prospects? Gerard, was there another question you wanted me to answer? I just saw that one.
Perhaps there's a second question. This will be the last one, and then we invite everybody that still has questions to contact the researchers directly, which can be found, of course, in our UTS Finance on the website. The second question: fund managers can disguise their holding by selling off some stocks right before reporting, and then buy them after the reporting. How do you know?
Window dressing, yes. David made this point as well. Well, actually, this is one of the applications of that. Lorenzo and I, a couple of years ago, read one of these window dressing papers in Journal of Finance. And what we were thinking to do is to say, well, if you could actually infer the holdings, you should be able to see that happen. So just before the quarter, you should see, in terms of what happens to the fund returns, that there's a sudden change of weights just before the holdings are disclosed at the end of the quarter or the end of the month. So that is, in actual fact, one of the applications of this, is to try and get a proper handle on how much window dressing happens. Because right now in the literature on window dressing is sort of very indirect. The measures of this happening are anecdotal, and the empirical measures are somewhat indirect. It would be really nice if you could actually, with some confidence interval, really say, look, I can see these weights changing just before the portfolio holdings are disclosed.
Thank you so much for your contribution, Hardy, and also thanks once again to David for his commentary. I would like to thank everybody for attending today's Finance Research Showcase. Please do not be a stranger and find and follow us on LinkedIn, Twitter, Facebook, and of course YouTube for the recordings of these events by simply Googling UTS_finance. A big thank you to our researchers for allowing a sneak peek into the engine room of their latest research, and of course a special thanks to David Walsh from Real Index Investments for his real work finance assessment and the work presented. Please visit our Zoom lunchroom again in the next weeks when we take a closer look at cryptocurrencies in our FinTech Forum series. You will find the event details on our social media websites. Please follow us on LinkedIn and Twitter in particular to get the alert. Until then, be safe and have a great weekend. Thanks once again for your time. We will see you soon in one of our Zoom events. Bye-bye. Thank you.